In this video, we're tackling the big question. Is it better to pay off your mortgage early or invest? Why is this decision so crucial for your financial future? Do you have extra money left after paying all your monthly bills and want to make the most of it? If so, you're in the right place. How can you optimally use the remaining funds to achieve your financial goals? First off, I just want to say, if you're in this situation, congratulations. Why aren't so many people in this financial position? The average personal savings rate in America is around 3.6%, and many people are living paycheck to paycheck. How can you stand out from this statistic and achieve financial stability? To figure out what's best for you, it depends on many factors, but the biggest factor is your mortgage interest rate. Why is your mortgage interest rate crucial for your financial decision? First, we'll break down how your mortgage payment is structured, because understanding this process is absolutely key to determining what's right for you. How does understanding your mortgage payment breakdown help in making informed decisions? Once we understand that, we can mathematically and financially answer what makes sense. What mathematical considerations play a role in this decision? Additionally, I'll share some strategies to help you pay off your home early if that's your goal, as well as other intangible factors to consider when deciding between early mortgage payoff and investing. What additional factors should be considered in this decision? So, let's start at a very basic level. When you take out a mortgage, you're buying a home with borrowed money from your bank. Why do banks offer mortgages and how do they benefit from them? You then have to repay the borrowed amount with interest over time, because that's how banks make money. How do interest payments on mortgages work? For example, let's say you borrow $400,000 to buy a house and get a standard 30-year fixed-rate mortgage. What does a typical mortgage plan look like? The bank makes it very easy for you by breaking down how much you need to pay them back monthly over the next 30 years or 360 payments. Why is the monthly breakdown of your mortgage payment important? Each monthly payment consists of two components, and understanding this breakdown is really vital in answering our entire question today. What are the two main components of a mortgage payment? The first component is the borrowed amount you need to repay over 30 years. This is called the principal. Why is paying down the principal so important? The second part of the payment is the interest on the remaining balance you haven't paid off yet. How do interest payments affect the total amount of your mortgage? For example, with a $400,000 loan over 30 years at a 7% interest rate, your interest payment is always calculated as follows. Your remaining balance multiplied by the 7% interest rate and divided by 12 months equals your monthly interest payment. How do you calculate the monthly interest on your mortgage? In the first month of your mortgage, a large portion of your payment goes towards interest, while only a small portion goes towards the principal. Why do so much of the mortgage payment go towards interest in the early years? Here's the fascinating or, crazy part. A mortgage follows what's called an amortization schedule, which is just a detailed table that breaks down each monthly payment on a loan. What is an amortization schedule and why is it important? In the first month of your payment, for example, $2,333 goes towards interest, and only $327 goes towards the principal. Why is the beginning of a mortgage so interest-heavy? This shows that banks front-load the interest payments, meaning you don't really make significant progress on the principal until much later in the loan's life. How does the structure of mortgage payments affect your financial planning? This becomes problematic because you're still being charged interest on the remaining balance without making much progress on paying down the principal. Why might it feel like you're never paying off the principal? In the first 20 years of a 30-year fixed-rate mortgage, your interest payments could still exceed your principal payments, leaving you with a substantial balance. How does the remaining balance of a mortgage persist over time? Let's look at an example. With a $400,000 mortgage over 30 years at a 7% interest rate, you'll pay a total of $558,500 in interest. Why are the total costs of a mortgage so high? At a 5% interest rate, the total interest paid over the life of the loan would be $373,000, and at 3%, it would be only $27,000. How do different interest rates impact the total costs of your mortgage? This means that if you can reduce your principal quickly, you'll pay off your mortgage faster and save a lot on interest. Why is paying down the principal quickly financially beneficial? Now, let's take a look at how stock market returns compare to paying off your mortgage. How do stock market returns influence your financial decision? Historically, the S&P 500 has achieved an average annual return of about 10.26% since 1957. Why is the stock market an attractive investment opportunity? If your mortgage interest rate is, say, 3%, and you instead invest in the stock market, you could achieve a significantly higher return. How can you choose the optimal path between paying off your mortgage and investing? In summary, if your mortgage interest rate is low, it's generally financially smarter to invest. Why does investing make more sense than paying off a low-interest mortgage? The longer you have to invest, the greater the potential benefits due to compound interest. How does the time horizon influence your decision between investing and paying off your mortgage? Finally, here are some strategies to pay off your mortgage faster without breaking the bank. Make bi-weekly payments. How can making bi-weekly payments accelerate your mortgage payoff? By having your monthly payment and making it every 2 weeks, you end up making 26 payments a year instead of 24, resulting in an extra payment that shortens the loan term and reduces interest costs. Make extra payments. Why are additional payments towards the principal so effective? Even small extra amounts each month can significantly shorten the loan term and lower the total interest paid. Use windfalls. How can lump sum payments impact your mortgage? One-time payments like tax refunds or bonuses can quickly reduce the principal and lower overall costs. Final thoughts. Understanding the financial dynamics of your mortgage and applying smart strategies can lead to substantial savings and financial freedom. Which strategies will you use to pay off your mortgage or invest? Share your thoughts in the comments and check out my next video, where I explain how much house you can afford.